One of the most common questions that I get around retirement planning, and one of the biggest decisions you're going to have to make for your retirement plan is, when do I take CPP, your Canada Pension Plan? I'm Joe Curry, founder of Retirement Planning Simplified.ca. And today I'm going to talk about some of the key factors when it comes to making that decision on timing of CPP. So before I dive into those key factors, let's just get clear on what CPP is. It is a pension that's paid out on a monthly basis to Canadians who contributed to the plan between the ages of 18 and 65. The amount that you get is going to depend on how many years you contributed, what your income was during those years, and the timing of when you take it. So you can take it as early as age 60, as late as age 70, and the standard age is age 65. For years, and honestly still today, I think that the most common rule of thumb advice is take the CPP as early as you can. And today I'm going to talk about why that's probably not the best advice. And if I think about why that advice is out there, there's a few things that I hear. For a lot of people, it's just they don't like the government. They feel like I've been paying this, what they consider a tax for their whole working career, and they just want to get their money back. And at the end of the day, I want you to approach this from the standpoint of what's the best decision for my retirement as opposed to a decision out of spite. And I think that the other thing is that most people, for whatever reason, think they're going to pass away sooner than what will likely be the outcome. And I'm not sure why that is, but time and time again, people just do not think that they're going to live as long as they probably will, or as long as life expectancy suggests that they will. There's one other reason why I think that people get this advice of take the money at age 60 or as early as you can. And it's the argument that, well, you can take that money and you could invest it and you're going to get a better return on that than you're going to get if you were to let the CPP continue to be delayed and therefore increase over time. And I hate to be the one to break this, being a financial advisor, but there is a direct conflict of interest between you and your financial advisor on this advice, because for your financial advisor, in most cases, they're getting paid by the amount of assets that they're managing for you. And if the advice is delay your CPP and take money to the portfolio, that is essentially reducing the income that they're receiving from having you as a client. So again, I hate to be the one to break that, but that's the other reason I think this advice comes up more often than not. So a few more details around the timing of CPP. As I mentioned, age 65 is the standard retirement age. Now, you can take it as early as 60, as I mentioned. And if you take it before 65, every month before age 65 that you take it, there is a 0.6% reduction in the benefit, the monthly benefit that you're going to receive. So that works out to a 36% reduction if you take it at age 65 years early. Now, the flip side of that is you could delay it until age 70. Every month you delay, there's actually a larger benefit than what the penalty is for delaying. And the benefit is 0.7% per month for every month you delay after age 65. So if you delay to age 70, what that means is an increased benefit of 42%. So we're talking about a pretty significant difference between taking it at age 60 to age 70. Let's get on to those key factors about evaluating the timing of your CPP. Now, first and foremost, I'm actually going to say, let's make our default recommendation to actually delay as long as possible. Okay, so there's some scenarios where we don't want to do that, but FP Canada, so Financial Planning Canada, Research Foundation, and the National Institute for Aging did some research on this recently. In 2020, they did a paper. And I'm actually going to quote directly from that paper. Getting the most out of CPP and QPP by delaying benefits is the name of the paper. They found that those who can afford to delay, who are in reasonable health, should consider delaying. And considering the impact of delaying CPP to receive an incentive of higher guaranteed income, and here's the direct quote, these incentives, combined with the strength of these programs, have made delaying CPP benefits for as long as possible the safest, most inexpensive approach to get secure, worry-free retirement income that lasts for life and keeps up with inflation. So here's the thing. If you're thinking about your retirement, if you're like most people I talk to in my office, we're not really worried about you running out of money in your 70s or even your 80s. The risk here is longevity risk, and this is if you're living past life expectancy. And that is where CPP comes in, and old age security, and if you have another pension. These are all guaranteed income sources. The great thing about CPP is not only is it guaranteed income for life, but it also keeps up with inflation. And most people want to do more spending earlier on in retirement. And so that's fine if you're spending some extra money out of your portfolio. Obviously, you need a plan for that and you need to be intentional about it. But later on in retirement, it's likely that you're not going to be spending as much money. And so if you end up spending your portfolio and now you're living into your 90s or your hundreds, then it's going to be nice if you have that guaranteed income that's going to hit your basic necessities at the very least, right? And if we take that benefit too early, we're not getting the bump up, and the difference is quite significant in what that guaranteed income looks like for life. Now, in I guess traditionally, people have kind of looked at, well, what's the break-even factor? And they try to figure out, okay, well, if I live past age 77, I'm going to be better to delay, but I don't know if I'm going to live that long. So I'm just going to go ahead and take it early. But rather than thinking of it as a break-even, you want to think of it from the standpoint of, what am I missing out on? What's the benefit I'm missing out on if I take this early? Here's an example from the FP Canada Research Foundation paper in 2020. A woman retiring in 2020 at the age of 60 who's eligible for the maximum CPP, taking into account inflation, would lose out on $155,200 of lifetime income in 2020 dollars, assuming she just lived to her life expectancy of 88 and a half years. So that's a pretty substantial amount of money. And again, that's only if she lives to life expectancy. So what if she lives beyond that? She's missing out on even more. Right? So that's why I want you to think of this in terms of, what are you potentially missing out on just by living to life expectancy, as opposed to thinking of it from a break-even standpoint. Okay? Just to summarize the factors we talked about here today is, one, just set your default to delay. The research done by FP Canada Foundation and National Institute for Aging in Canada is pretty clear that for most people, delaying is going to be beneficial. We also want to think about when you're going to run out of money. So most people are not going to run out of money in their early 70s or even into their 80s. It's going to be beyond life expectancy, right? So make your decision with that in mind. Don't think about the break even. The break even doesn't really matter. What really matters, again, is living past that life expectancy and thinking about what you're going to miss out on. So again, a female retiring at age 60 lives to life expectancy, well over $100,000 of missed out on retirement income she would have had she delayed CPP to age 70. Okay, so that's very impactful. Other factors that would say we should take this earlier, again, do you have a shortened life expectancy? Do you need the money today, right? So I know I talked about the default. Doesn't mean that you always should delay, but that's a pretty good summary of some of the key findings. Now, this isn't the end all be all, but that should give you a really good start to get thinking about that retirement and retirement timing of CPP. And if I just add one more factor to this, the other argument, and this is something that we've built into planning for clients where we recommended taking it earlier, is if you retire before a certain age, because now all of a sudden you have years where you're not working and not contributing to CPP, so it brings down your average earnings. But unless that's substantially early, what happens is the increase you get from delaying far outweighs the benefit that you're losing by having that lower average brought down, right? So both are happening. The average earnings is coming down, meaning lower benefit paid out, but you're getting that bump up, which works out to be higher than what the reduction in earnings and average payout is. So I hope that's been helpful. Again, if you want to find more about this or anything retirement planning related, just find us at retirementplanningsimplified.ca.
Thank you for joining us for this latest episode of Your Retirement Planning Simplified. Be sure to tune back in for the next episode. And until then, we're here to help you simplify and succeed in your retirement planning.